investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the SPDR Dow Jones Industrial Average ETF, ticker symbol DIA. And as I zoom in, you'll see that today we did gap up in the market on the economic news that came out with regard to employment, and the gap up is what we have to be most concerned about, because when the Dow gaps up like it did today, there's an 80% chance that the gap will fill. In other words, there's an 80% chance that the market will be drawn back to fill this gap. And if you look closely enough, there's a gap below the market down here right around 173.5. Now, this doesn't look like much of a move down to this gap level, but that would mean almost 1,000-point drop in the Dow if this gap winds up filling. Look in the past and you'll see here's a gap that ultimately filled. There's a minor gap that filled there. We have a small, very small gap here. And you can see, even if I back up the chart, the gaps over time, even going so far back here, the gaps ultimately fell. And this is when the Dow went from 17,200 all the way up to 18,000 and then pulled back 1,000 points here to fill that gap. We even had small gaps down below the market here. I'm not going to really focus on that right now, but my point is, don't be drawn into what I would call a bull trap. This is when it looks, on the outside it looks very bullish, but then we hit resistance areas here. There's another resistance area up here, and what happens is people get bullish, they buy at the top, and then the rug gets pulled out from under them, and boom, they get hit with very little risk management strategy behind it. So I'm still not bullish, and I'm not buying into this labor report, because if you look at what's come out today, the news isn't really that great. In fact, there is a new record of Americans not in the labor force, and that number has now reached 93,194,000. And if you look at the data that's coming out on some of this chart, this black trend line right here are the people who are not in the labor force, and there is no slowing down in that trend. Don't be fooled by unemployment numbers. Just because unemployment might be low, that does not mean people have gone back to work. It simply means they've fallen off the unemployment rolls and they're no longer receiving benefits from the government. They then fall into this category of people who are not in the labor force, and that number is dramatically increasing. Do not be fooled by that, folks. This is not a bull market that you should be buying into and holding. In fact, this is a buy and protect on the breakouts, but it's a very defensive market. In fact, we are looking to take a bearish strategy, and our subscribers are getting recommendations from us to buy into the bearish funds. So that's the Dow right there. The Russell 2000, I'm going to give you a more broad-based market, is following exactly the way I thought it would. This was the trend line that I forecasted, where I thought the Russell 2000 would move up in an attempt to fill this gap, which it did today. But there's a doji there, and it's leaving gaps to the downside just like the Dow has. There's a gap here today. There's a gap down here that I've already identified, and a gap much lower in the Russell 2000. So I'm leaving this forecasted trend line in place, where I think ultimately we're going to hit this line and then start to pull back and become bearish on the Russell 2000. Remember, the Russell 2000 is a more broad-based index. It's much more significant than the Dow, so don't be fooled by the Dow numbers. Looking at the Qs, that's QQQ, the power shares for the tech sector, we followed suit again, where I said we would more or less bounce off of this trend line. It did that. We gapped up here. And again, when the major indices and other indices that are commonly followed start to gap, the caution flag goes out even more. So I still think that we can maybe go a little bit higher in the Qs, but ultimately come back down to fill the gap. Looking at the spiders, this is the SPY, the S&P 500. We did breach the lower line here in the triangle, but now we're up against the upper resistance line of that triangle. So I'm going to move this line and just simply readjust that to forecast this trend. And I think we're going to pull back from resistance next week and then ultimately break down below this line once again. So, what are we left with? The VIX. The volatility index is the most important index that you could be following right now because this is the leading indicator. We gapped down on the VIX. Remember, this is a contrarian indicator to the S&P. So when the S&P gaps up, the VIX is going to drop down. I've left my forecast lines in place. They're still following, with this being support down here right around 1234, and my forecasted trend or upward leg is in place. So when the VIX starts to move up, watch out below in the Dow, the S&P, the Russell 2000, and even the Qs. Remember, the data that's coming out from the Bureau of Labor Statistics is not something that you should take at face value, but dig in a little bit deeper, read between the lines, and understand that there are more people out of work today than at any other point in history for the U.S. economy. That is not good, and the Fed is moving away from any kind of talk of raising interest rates because they fear that they'll spook the market lower, and that's exactly why they're keeping a lot of that data quiet. Do not be fooled, folks. Stay defensive, stay bearish in your long-term outlook, and make sure you're using protective stops, and we'll go from there. So this is AJ Monty of The Market Guys. Thanks for listening, and have a great weekend. So long.